In the previous video, we accounted for inventory purchases and examined inventory costing issues. Here in part 2, we will account for inventory sales and take a look at the merchant's income statement. When the merchant makes a sale of merchandise inventory items to a customer, two things happen. One is that revenues are earned, so assets go up, either cash or accounts receivable, and owner's equity goes up as well. Remember, owner's equity is increased by revenues. But to make the sale, the merchant had to give the customer inventory items, so another asset, the inventory account, falls. This is recorded as a business expense, so the owner's equity in the business also falls. Expenses decrease owner's equity, and this expense is called cost of goods sold. Only someone engaged in merchandising would use this expense account. To record a cash sale, then, the merchant would debit cash and then credit the revenue account used for revenue from sales. This is called the sales account. But then the cost of the inventory items has to be recorded as an expense, so the merchant will also debit the cost of goods sold account and then credit the inventory account. If our merchant sells inventory items that cost $100 for $150, then the merchant has made $50 on the sale. This difference between the revenue from the sale and the cost of the goods sold is called gross profit. In this example, the merchant would have made $50 in gross profit from this sale. Gross profit from sales is the major determinant of the net income amount that is reported on the merchant's income statement. We're looking at the merchant's income statement here, and you can see that we do have our sales and cost of goods sold accounts reported among the revenues and expenses. The statement, though, is set up in what is called a single-step format, with all the revenues combined together at the top of the statement and all the expenses at the bottom. Then, in one single step, expenses are subtracted from revenues to determine net income. This single-step form for the income statement is not particularly helpful to income statement users. These people are usually investors. And in addition to knowing just how much profit the company earned, these users would like to know how this profit was earned. That information can better be understood when we use a multiple-step income statement format. We've now rearranged our statement, turning it into a classified multiple-step statement. Instead of subtracting all the expenses from all the revenues in one single step, we're now classifying revenues and expenses as to type and going through a series of additions and subtractions to finally arrive at bottom line net income. In the first step, sales is listed along with cost of goods sold, and the two are subtracted to determine a gross profit figure. We're not at net income yet because there are still other revenues to add and other expenses besides cost of goods sold to subtract. Next, we see a section called Operating Expenses. These are the selling and general administrative expenses that were incurred in operating the business. They're totaled up here and subtracted to give us a profit figure called income from operations or operating income. We then subtract other expenses that would not be classifiable as operating expenses, and if we have other revenues in addition to sales revenue, we would add them. And once we've added and subtracted these other items, we'll arrive finally at net income, the final step in our multiple-step income statement. Before we leave this example, let's make a few points about operating expenses. Note that we have two different types. The selling expenses are the expenses that were incurred to make the sale. So, the advertising expenses, the salaries for sales clerks, and other kinds of sales-related expenses would be classifiable as selling expenses. The back room, behind-the-scenes expenses of operating the business, for example, the office bookkeeper's salary, would be classified as general and administrative expenses. These expenses are all necessary in order to operate the business. Any revenues or expenses that aren't required in operations, we classify as other revenues or other expenses. These are things like interest revenue, interest expense, gains and losses from the sale of investments or equipment, and things like that. Sometimes, after goods are sold, the buyer finds defects and brings them back to the seller asking for a refund. The merchant might take the goods back and then refund the customer's cash, or if the sale was made on account, reduce the customer's account balance. This is referred to as a sales return. Sometimes the customer keeps the goods and the merchant allows the customer a reduction in the sales price, refunding the cash or reducing the account balance because of the defects. This is called a sales allowance. Both sales returns and sales allowances are recorded in the same account, called sales returns and allowances. This account is debited and cash or accounts receivable is credited to record a return or an allowance. Sales returns and allowances is contra to the sales account. We'll examine it in detail in just a minute. There's one difference though between sales returns and sales allowances. If the item is returned, then the merchant places the item back on the shelf and then tries to sell it to someone else. In this case, the good that originally was sold turns out not to have been sold after all. And we'll need to reverse the cost of goods sold entry that was made when the item was originally sold. At the time of the sale, we debited cost of goods sold and then credited the inventory account. But if the item comes back and is placed back on the shelf, then we need to reverse this. We'll put the item back into inventory, debiting the inventory account, and reduce cost of goods sold with a credit, since the item turned out not to have been sold after all. On the other hand, if an allowance is granted, then no second entry is made at all. After all, if the goods aren't taken back, there's no reason to do anything with inventory. This screen illustrates the way that sales returns and allowances would be reported on our income statement. As we said earlier, sales returns and allowances is a contra account to sales. This is shown on a multiple step income statement where sales returns and allowances, a debit balance, is subtracted from sales, a credit balance, to calculate net sales. Net sales is not an account. It's just a label on our statement, and it represents the amount that the goods were actually sold for. In the previous video, we explained that when sales are made on account, credit terms will be applied to the sale. We examined all of these terms in the previous video, and we noted at that time that the terms 210 net 30 indicated that a 2% cash discount could be taken off the invoice price if the buyer paid within 10 days of the invoice date. When the seller offers credit terms like these to the customer, and the customer pays in time to take the discount, then the seller needs to record a sales discount. Sales discounts are not expenses of the period. They instead represent another reduction in sales price that the seller provided to the buyer for early payment. We treat them as we did sales returns and allowances, as a reduction in sales, and we record them in a contra account called sales discounts. This account is listed on our income statement along with sales returns and allowances. Both are subtracted from sales to determine the net sales of the period. In the previous video, we looked at an example in which a $100 purchase was made with terms 210 net 30. In that video, our merchant purchased the items and paid within 10 days, taking a 2% cash discount. We explained that a discount on a purchase represents a reduction in the cost of the inventory and would be recorded with a credit to the inventory account. If we think about this transaction on the books of the seller, though, things are different. In that case, when the discount is taken by the customer, our merchant will record the collection of less cash than the amount of the balance in accounts receivable. The debit difference in the entry made to record the collection will be recorded in the sales discounts account. As we just explained, sales discounts are contra accounts to sales on our multiple step income statement. Let's take a look at the income statement and see how these discounts, along with the returns and the allowances, are reported. We see here that the balance in sales is being reduced by the sales discounts that were taken, as well as the sales returns and allowances. in order to arrive at a net sales amount. Note that the invoice price, $5,000, was reduced by sales returns and allowances of $50, and then because the customer paid early, another $2 was taken off the sales price. So the net amount received from the customer overall from the sale was $4,948. We've now examined all of the accounts that will appear on our multiple step income statement. We see the complete statement here, and we mentioned earlier that investors will appreciate the information that's provided in the multiple step form statement. Let's see how this information could be analyzed to help determine how profitable the company really is. We see that sales are $5,000, but $52 were given up through discounts, returns, and allowances, so the net sales are only $4,948. This means that $52 out of $5,000, about 1% of sales, were lost due to discounts, returns, and allowances. Is this a good number or a bad number? It all depends on what the competition is able to do. If competing firms are able to get away with 0.5%, then our company may not be doing too well. On the other hand, if the competition has 5 or 10%, then our company would appear to be doing a good job. We also see that the cost of goods sold is $3,000 and gross profit is $1,948. This means that the company purchased goods that cost $3,000, marked them up by $1,948, and sold them for $4,948. This is a percentage markup of 65%, which is a pretty large figure. Companies that have high quality goods that are in demand are able to apply large markups. Selling expenses are $1,000. This is 20% of sales revenue. Is this too high, or is it perhaps not high enough? Is the company spending too much on advertising and sales commissions, or not enough? Again, we would need to compare this percentage with the competition to make a judgment call here. The general administrative expenses are 10% of total sales. And again, we need to see what it's like for the competitors before we can decide whether this is a good figure or not. Overall, income from operations is $448. That's about 9% of sales revenue. The other 91% of the sales revenue was lost to sales returns and allowances, sales discounts, cost of goods sold, and the operating expenses. Is this a good figure? Well, again, we would have to look at the competition in order to decide. The other revenues and other expenses are inconsequential since they're small in amount. We might want to look into them further, though, just to make a complete analysis of our merchant's ability to generate profits. There are two additional items we need to discuss before we begin our video. One is a trade discount. Trade discounts are not the same as purchases discounts or sales discounts, which we just discussed. Trade discounts are never reported in the accounts. Instead, they're simply a pricing mechanism. A buyer calls in to the seller and asks for a discount below the seller's published list price. And if the seller grants the discount because the buyer is making a large quantity purchase or for some other reason, then the buyer is being given a trade discount. Trade discounts simply determine what the invoice price will be, and therefore will never be recorded in the accounts or reported on the income statement. Another thing we need to discuss are sales taxes. In most states, the merchant is required to collect sales tax from the buyer at the point of sale. If we're in a state in which the sales tax is 6%, then if a $100 sale were made to a customer, the cash collected from the customer would have to be $106. The merchant is responsible for collecting the 6% tax on top of the sale that was just made. The merchant must remit this tax to the state at the appropriate time. Therefore, the merchant has a liability, and we call this liability sales tax payable. So our entry to record a sale would be to debit cash for the full $106 received from the customer, then credit sales for the $100 of sales revenue that has been earned, and then credit sales tax payable for the $6 that has to be remitted to the state. This completes part 2 of our merchandising video, and I hope it has been helpful to you.